Right, well, it's a real pleasure to see you again, Robin. I've been watching all of your videos again, which was still a pleasure second time round. So maybe you'd like to give us a little bit of background about your company and what you've done in the past.
Okay, I am Executive Director of Ember Regis Group Limited. We're based in Birmingham. We produce content for really all manner of organisations, but we have over the last few years come to specialise in the financial sector, and particularly in what I would call kind of disruptive financial sector. So financial firms, be it advisors, wealth management companies, fund managers, fintech companies, consultants, who are actually trying to make a positive difference. And I know that sounds a little bit wishy-washy, but I think you can actually make a very clear distinction in the financial world between companies who, we've all got to make a profit, everyone's got to make a profit, we accept that, but who genuinely do have the consumer's interests at heart. They're the companies mainly we work with. I'm actually a journalist by background. I worked for more than 20 years for ITV, BBC and Sky News. You get to a certain age where you either move into radio or you do something else. So I set up a content marketing company. And I actually ended up focusing in the investing space really by chance. Pretty much the first client we ever had was a wealth management company here in Birmingham, which said, look, we have researched, over the last couple of years, the best way for people to invest. We have found it. We think it's great. And we work mainly with high net worth individuals, but we believe that every investor can benefit from this type of investing. We would like you to make a film about it. And we did. And that's how it all started.
That's amazing. And you've actually come up with the idea of evidence-based investing. I think you created the term, is that right?
Right, well, there is some debate about this. Our first documentary, that film I told you about, was called Passive Investing, The Evidence. And as you well know, Ramin, passive really doesn't tell the whole story as far as evidence-based investing is concerned. It's not just about the kind of funds that you use. It's about behavior. It's about taking a long-term approach, a diversified approach, and so on. So passive didn't really kind of cut the mustard. So when I started a new blog a couple of years ago, took soundings from various people around the world about what they thought would be a good name for it. Dimensional Fund Advisors, which is a company that I greatly respect, uses that phrase quite a lot. Also a guy called Larry Swedroe, who you may be familiar with, works for the BAM Alliance based in St. Louis in the US. His view was very much that evidence-based investing was the best name for it. And lo and behold, would you believe it, there is now an evidence-based investing conference in the US on both the West Coast and the East Coast. We've had 3 so far, and they're going to be every kind of 6 months or so. I would love to say, Ramin, that was something to do with me. I love the event. We, as a company, sponsor the events. I've been to the events, but no, I don't organise the events, but I'm happy to bask in the reflected glory of the evidence-based investing conference.
So let's just say about passive and active investing, just in case people who are watching who don't know. I mean, it's very unlikely because they probably watch your content or my content, in which case they would know, but active and passive, very different things. So what's the difference between the two?
Just very, very briefly, active investors try to beat the market. They try to do that in 2 ways mainly. One, by stock selection, picking stocks that they think are going to outperform the market, and ditching ones that they think are going to underperform. And the other way they try to do it is through market timing. In other words, just getting into the market just as markets are about to go up, and getting out again just as they're about to fall. Now, all the academic evidence says that although that seems a reasonable thing that people should be able to do, particularly clever people and people who research the markets and carefully research individual stocks and so on, in practice, it is extremely difficult to do. But a passive investor will say, look, I don't know which of these stocks are going to outperform. I don't know when the next recession is going to strike. So I am going to just go with the market, keep my costs as low as possible, and simply to rebalance my portfolio every year or so. Because, of course, as time goes by, and for example, as stocks go up, and of course we've had this amazing bull market over the last few years, as a proportion of people's portfolio, stocks have actually become much larger. So in a sense, investors are taking much more risk than they were when they originally set out. And so every year, I would say, every year or so, you should just simply rebalance to restore your original asset allocation.
So if the shares have gone up a lot, they'll form a larger part of your portfolio, so you sell some of them and move some of the money into bonds.
That's right. In a sense, you're actually doing the opposite of what instinctively you would want to do. I mean, typically investors chase performance, and as stocks do well, they continue to pour more and more money into stocks, and that's not necessarily the best thing to do. And so that's why rebalancing is a really good discipline to have.
Well, one of the points that Jason Butler made in the videos which you created is that passive is perhaps a bad name for this approach to investing, because you're not passive at all.
Yeah, I mean, I thought that quote from Jason Butler in the film is just spot on for benefit of those who haven't seen it. He says something along the lines of, it shouldn't really be called passive investing. Passive investing is misleading. I think smart investing, he says, is a more appropriate name. It's a kind of no regrets investing. It's a way of ensuring that you are going to get maximum benefit from taking part in global capitalism and enjoying your fair share of the profits of capitalism.
One of the things you talk about is the different types of risk. Basically, my background is in investment banking, so I used to teach people about volatility. So volatility was always the way we thought about risk, and volatility is just the typical daily price move of an asset. So it goes up 2% or down 2% typically in a day. That's its volatility. But you talk about different types of risk, which I thought was very interesting.
Yeah, I mean, I think people confuse risk and volatility. And again, in the film, in that particular part 4, Jason Butler explains that they are two very different things. If you have a long-term investment horizon, then you can clearly expect lots and lots of volatility between now and, 2050 or whenever it is you're looking to retire. But that's not to say that you are necessarily taking a great deal of risk with your money. And by risk, I mean risk of permanent loss of the money you invest. As Jason says, we're really talking about things like nuclear war, which is, of course, is not impossible. Let's be honest. But we shouldn't laugh about these things. But possibly recent events have brought that into particularly sharp focus. And of course, Jason also mentioned an asteroid situation. Where we're the Earth is hit by an asteroid. I mean, unless one of those things happens, you know, it is very, very unlikely that you are going to lose most or certainly all of your money. And as for volatility, well, we should just learn to get used to it, frankly. Richard Thaler, who was recently awarded the Nobel Prize in economics, he once said something along the lines of, you know, Rip Van Winkle would have made a brilliant investor, because basically he would have invested his money, he'd have gone to sleep for 20 or 30 years, he'd have woken up and everything would be hunky-dory. The problem is, of course, in real life, we live life in real time, and we're constantly surrounded by this noise about things happening and going wrong, and, you know,
or Bitcoin. Bitcoin's a really nice example, isn't it?
It is. I mean, these are distractions. I mean, I would call Bitcoin a kind of one of those shiny things that investors are often kind of sort of put off by, which seem very appealing. And we hear these stories about people who've made masses and masses of money, and weren't they clever, and so on. Well, I don't know, they may have been clever, they may just have been very, very lucky. And you know what, if they're still holding on to that money in the hope of maybe making, you know, yet more profit out of it, then they may well come to regret it when eventually, as I expect will happen, Bitcoin starts to plummet in value.
But the thing is, for a journalist, Bitcoin's a gift, because its price is always moving hugely. It crashes, it rallies massively. And even in the FT, they've started tweeting about when it crosses a multiple of 10,000, which I thought was just atrocious. But what I love about your content, Robin, is that you always have come up with the same content about the same point of view, which on the face of it seems quite boring, but in fact is incredibly important. I mean, it's very hard not to be boring when you're talking about evidence-based investing, because essentially the facts don't change, right? You produce a diversified portfolio, you invest in cheap funds, you stick in it for the long haul, you don't tinker with your portfolio, so you actually have to ignore a lot of the news flow. So in essence, it must be really hard to put out the content about this approach to investing. Is that the case?
Well, yeah. I mean, I'm a journalist, you know, and journalists thrive on stories, and you know, we want people to buy our newspaper or watch our news program or whatever it is. Frankly, you are not going to you know, sell newspapers by telling everyone every week that what they ought to do is just buy low-cost index funds and forget all about it. I actually once put this question to Kenneth French of sort of Farmer French fame at Dartmouth College, and he said, "Look, the problem, Robin, is that people don't want me on the front page of their investment magazine every week." It's a bit like the diet industry, you know. We all know that the best way to lose weight is to exercise more and to eat fewer calories. And yet, you know, we're far more interested in stories about, you know, miracle sort of diet products, or, you know, if you eat grapefruits or drink lots of coffee or whatever it is, you'll be slim. We find that much more interesting, and we chase those kind of shortcuts. We shouldn't. You know, investing is boring. It's not, I suppose, hard work in the sense that, you know, slimming is and proper dieting, but it's not exciting. There are no
exciting if you do it right. Okay, is that a fact?
You've got it. I mean, yeah. I mean, you know, if you're gonna look for excitement, we'll go to, you know, Sun City or Las Vegas, or you know, take up you know, deep sea diving or parachuting or something. But don't gamble with your life savings.
One of the things you say is that the real risk is that you don't achieve your desired lifestyle.
Exactly. I mean, it's a huge risk of actually running out of money before you die without, you know, to put it too bluntly, we're all living longer. You and I, if we look after ourselves, could live to 90 plus. Our children could live to 110. And if you're going to retire at say 65 or 70 or whatever, even 70, I mean that's still a heck of a long time without guaranteed income. We're very attuned as a race, and I think there's some interesting theories as to why this is, and it's partly evolution. The sort of and the fight or flight principle that human beings, thousands of years ago, faced with dangerous animals in the wild, would be attuned to those kind of risks. What humans aren't attuned to, the sort of risk we aren't attuned to, are these kind of long-term, slowly evolving risks that in many ways are actually, not necessarily more serious than being eaten by a lion, but they are actually very, very serious. I mean, people could seriously end up having to rely on the state or on charity in their retirement,
or on their own family, which is sometimes worse.
And they may not, their family might not be willing to. They may not have surviving relatives to help them. It's a worry.
And the other risk is not getting involved. So if people don't actually invest, then obviously they don't have the pot in order to draw in future. So taking too little risk can be a problem as well.
Exactly. I mean, risk and return are directly related. I mean, it's the most obvious sort of starting point of investing and understanding how investing works. But it's so true that and we shouldn't necessarily think of returns as great and risks as the opposite. The two, they're two sides of the same coin. You don't get the return without taking the risk.
And if you want more upside, you have to take greater risk. I think people often forget that.
Exactly. I mean, there is a misconception, of course, as well, that if you take risk and that's a guaranteed return.
Yeah.
Of course, it's not. Otherwise, it wouldn't be a risk. But yeah, generally speaking, you're right. Yeah, the greater the risk you're willing to take, the greater the risk you can absorb and manage and feel comfortable with, the greater the returns you can expect over the long term.
And you actually talk about the long-term returns to expect on different assets based on some research that one of your interviewees talks about.
Dimson, Marshall, Staunton at London Business School. Yeah, they every year they bring out what they call the Global Investment Returns Yearbook, which is a very kind of weighty tome, but it's really fascinating. And basically, they've looked at market returns from 1900 to the present day, and they update it every year. So,
for example, if I just read out some of the returns that they found over the period from 1900 to 2016, cash was about 1% real return, bonds 2%, shares 6%, and I think UK shares about 7%. But what is this real return, and why is it important?
Well, real return is simply taking into account the effects of inflation. The pound in our pocket today will be worth less in probably in a year's time, 2 years' time, 3 years' time. So this is why, particularly times like this, where returns from cash and bonds and so on are relatively low, in fact very low, historically very, very low, for all the talk about the stock market being high, and certainly it's been on an incredible run, if you are going to achieve inflation beating returns, you really do, for the long term, have to be invested in stocks. There's no two ways about it.
Because they give you very high real returns above inflation.
That's right. Yeah, exactly. You can expect plenty of volatility along the way. There's lots of talk in the media at the moment about the possibility of a crash or serious correction. This time of year, I don't know if you noticed, Ramin, is very much forecast season. Everyone is making their forecasts about the year ahead. The thing is, if you look back at the forecasts that were made 12 months ago, almost all of them are pretty wildly off. And it's not just this year. It happens year after year, and yet the media trots out these sort of market forecasts, every December and New Year, and investors take them far, far more seriously than they should.
It's interesting though, because if you talk about the long term, you can actually make much better forecasts, but nobody's interested. So if you say over the next 20 years, I think these will be the returns you'll get, which Vanguard actually do. They say, look, over the next 10 years, these are the returns we expect.
Exactly. I've actually been making a series of videos for a client in America about Francis Galton, the famous statistician, and he actually developed a machine called the Galton board or Quickhunks, and basically it's this pattern of pins on a board, and basically there are some lead pellets which he dropped from the top, and every time they hit a particular pin, it was 50-50 which way these shots went, and what he got at the bottom was this a bell curve, and it's really fascinating to see this piece of equipment from the 1870s. Our client, Mark Hebner at Index Fund Advisors in California, actually commissioned his own replica of this Galton machine, which he's got in his office in Irvine. And it's the most amazing piece of equipment. And every time the balls are released, you get this same bell curve. So, in other words...
It's funny, because I used to use that when I used to teach options. When I was teaching options at an investment bank, I used to use the Galton box as an example of, this is the distribution you get, the normal distribution, even though each of the pins that the balls hit, there's just a 50% chance that it goes left or right. At the bottom, you get this reproducible bell shape.
Exactly right. So no one's got any. Warren Buffett says, he's got not a clue where the stock market is going in the next week, the next year, the next 2 years. But over the long term, we can be fairly confident that stocks will outperform cash and bonds, and will, for the patient investor, deliver a satisfactory outcome.
So Robin, can you tell me just a little bit about content marketing? Because this is one of the ways in which you help financial companies advertise their products, but also the services they provide.
Content marketing is hugely important, and really it's come as a result of the internet. If people want to buy something, they're looking for a product or service, they're looking at how to invest, or they want to find a financial advisor, for example, the first place they look is online. And we'll do, buying a fridge or a car or a house or whatever it is, that's where you look. And so as a company working in, for example, financial advice or financial services, if you're not easily found on the internet, how do you expect people to to find you. You have to produce content that people are interested in, but also that they want to share and engage with. There are some really exciting advice firms in around the world now that are using content marketing to grow their businesses, and that's very much something that we're part of as well.
So it's almost like storytelling online, isn't it? In fact, that's how I found out about you. I just saw your content online, and I just thought, God, these comments are just great. This guy's spot on.
Well, storytelling, from the beginnings of time, have been the way that humans have communicated with each other, in a negative sense, you could actually say that stories are the way that the active fund management industry has managed to remain so awesomely profitable for quite so long. But advisors, everyone has their own story. You, Ramin, have your own. I've got my own story, and people relate to stories. And it's not just in financial advice, whatever sector you're in. You have to use your content to tell a story, tell a story about yourselves, about what you can offer, about the way the world's changing, and so on. And the best companies are investing in high quality content and sharing that content.
But they also seem more human. If I just see a big company online, I just don't feel any kind of affinity with them at all. But if I see Joe Bloggs, who works on the trading floor or as one of the IFAs, somehow I connect with that on a much deeper level, and I trust that company more than if I just see the usual pastel-coloured cartoon with the banjo music in the background.
Absolutely, and there are some professions, sectors of the economy for which that kind of trust is particularly important, and I can't think of one actually where it's actually more important than financial advice. I mean, you are literally looking for someone to manage your worldly wealth. You have to trust that person, and content is a great way of doing that, and video content in particular. I don't know if you're aware of a guy called Michael Kitzers, but he's very well known in America. He's an excellent blogger, prodigious blogger. He writes about the financial advice profession. And he once told me that he also is part of a financial advice company in Washington, D.C. And he actually explained to me that they have videos of all their advisors online. And so when people come to find their firm through the content that they put out there, they go onto the website, and before that initial meeting, they've even decided which advisor it is they want to work with because they identify with that particular one. It just shows how powerful video is.
I find exactly the same. So people come to me and they say, look, I've watched all of your videos. And you think, okay, well, there's got to be a problem there straight off the bat if they've watched all of them and survived. They kind of know you, right? Because they've seen you talk about stuff and they feel comfortable with you. So it kind of pre-selects your audience in that sense, which is great. Mm-hmm. So that's how you've been helping financial companies.
Yeah, so we work with advisors all over the world. We're based in Birmingham, in England, but we actually have more advice clients overseas than we do in the UK, particularly in the US, where, of course, evidence-based investing took hold first, really, in the world. Yeah. Australia, New Zealand as well, it's taking off. We have a number of clients there too. And yeah, we basically help them primarily to educate their clients, to explain what investing is all about, how it works, and really, in a sense, to undo a lot of the damage that has already been done in terms of things they've read in the media or things previous advisors have told them and so on. So it's about client education. It's about building trust. It's about reassuring clients as well when inevitably markets go through rough periods. So it's about client retention, and ultimately, yes, of course, it is about attracting new business. Persuading prospects that you are the people they need to be working with. So it's not all about growing a business. It's about adding to the customer experience, the client experience, if you like. But what we're seeing is firms who invest in content marketing are the ones that are seeing growth.
That's certainly true. So just to finish up, I love your content. What else do you have in the pipeline for the next 6 months to a year?
We're talking to all the time to advisors about content that they're thinking of making. We would love to make more documentaries. We eventually will make versions for different markets, almost certainly America, probably Australia, but other countries too. We produce content in German and Dutch as well. We'd like to produce content in other languages, French, Spanish, we've been asked about, Italian in the past. But basically, we need to work with advisors, and we can't fund it ourselves. We work very cost effectively. We produce very, very good value content, but ultimately we need somebody to pay for it. And our experience is that actually that initial investment over time repays itself again and again, because content is always there. You can put an advert on a station platform and it'll be up for 4 weeks and then it'll be gone, or you could put an ad in a newspaper and today's newspaper ends up lining the budgie cage tomorrow, or in the wrapping fish and chips or whatever. But actually with content, it's there. There are videos that we made 5-6 years ago that investing videos that have amassed 20, 30, 40,000 views, and those views are continue to go up today. So it's a good long-term investment that doesn't go away.
Thank you so much for speaking to me, Robin. I really enjoyed talking to you again, and I look forward to seeing your content in future.
Thank you, Ramin, and well done to you as well for all the work you're doing in educating investors. Good for you.
Thank you.